Okay, Bismillahirrahmanirrahim. Previously, we have looked into the transfer price, the negotiated transfer price, and the cost base. Now, let's look at the third one, that is market-based transfer price. So, based on the existing market price, okay, on competing goods. So, if you base, as the name implies, okay, market-based. So, you set your transfer price based on the market price, and often considered best approach because it is objective, okay, and generally provides the proper economic incentives. That means, why you say it is objective? Because you know how much is the market. The market price is actually determined by the market forces. So it is objective in that sense. You know how much is the price outside. And then it is indifferent between selling internally and externally. Why? Because if you sell internal, you are taking that price. If you sell external also, you are selling at that price. So you are using the same market price. So there will be indifferent. So that can lead to bad decisions if you have excess capacity. Why? Because there is no opportunity cost. Okay, when there is not a well-defined market price, then companies use cost-based system. So this one we will look into if you have excess capacity and no excess capacity. Okay, for example, the plastic division of Western company manufactures plastic molds and then sell them for 70 ringgit per unit. Okay, they sell outside for 70 ringgit per unit. Variable cost 30, fixed cost per unit 10. And then management, that means the company as a whole would like the plastics division to transfer 10,000 of these molds to another division within the company. So the management means the company as a whole would like them to have an internal transfer, and the internal transfer is 40 ringgit. Okay, if you sell outside, the price is 70. So the plastics division is operating at full capacity. That means the selling division is operating at full capacity. What is the minimum transfer price? So the minimum transfer price that plastics division should accept, if you base your transfer price on the market, okay, you are using the market base. So what do you think the transfer price would be? Is it 40? Okay, is it 10? Is it 30? Or is it 70? So if you are basing your price on the market, then of course the answer would be 70, right? So 70. Okay, you just base on the market. So effect of outsourcing on transfer price. So outsourcing is basically you are contracting with an external party to provide a good or service rather than doing the work internally. So you just outsource the work to the external party. So virtual companies outsource all of their productions, use incremental analysis to determine if outsourcing is profitable. Again, if you want to decide whether you want to outsource or not, then you can use the incremental analysis. So as companies increasingly rely on outsourcing, fewer components are transferred internally, thereby reducing the need for transfer pricing. So transfer pricing is basically you are looking at the transfer between divisions within the same company. But now if you are using outsourcing, then that can reduce the need for transfer pricing. What if the transfer price occur for divisions that resides in different countries? So companies globalize their operations, so going global increases transfers between divisions located in different countries. You just need to be aware of the different tax rates, make determining appropriate transfer price more difficult. So you just need to know that if you are doing a global transfer price, that could be a tax implication with regard to that. Okay. So that is basically things that you need to know with regard to the transfer price for this method. That means you need to know there are three ways on how to determine the transfer price: the negotiated, the cost base, and the market base. And then you need to also be aware about the tax implication when you have divisions that resides in different countries, or you have a transfer price within different countries. Okay, so with that, I thank you.